following is a paid program. The opinions expressed are not necessarily those of WNBU and Interbanks Media. Welcome to All Things Money with David Blain, a thoughtful and revealing discussion of actionable ideas and effective strategies to help you through the complex world of investing, taxes, and real estate. Now, with All Things Money, here's David Blain.
Hello and welcome to All Things Money. I'm your host, David Blain. We thank you for joining us today. Got a good show lined up for you. I'm going to give some good investment principles. The past couple shows, we've been trying to talk about some timeless things. As you probably know, all of our shows from the radio and TV get posted on our website, and so we try to make sure that what the information we give is timeless, so that people going to our website a year from now, 2 years from now, that it's not all about what happened this week and economics and things like that, but it's time-tested principles that you can use for the future. So we encourage you to head over to our website. In fact, this week will be our last show for a while. As most of you know, I acquired a firm out in California. We're going to be spending some time integrating that acquisition and a few other things. So we're not going to be live on the air here for probably for the rest of the year at least. But we'll continue to be posting some content on the website, some other advisors in the office, writing some articles and some things like that. But so I wanted to leave this wrap-up show for the year here with some good principles for you. First of all, remember when you're investing that you're investing for a long time period. If you're investing, a lot of people confuse the term saving and investing. And saving, the distinction between saving and investing, saving is taking a certain portion of your current income and setting it aside for things like emergencies, purchases that you know that you're going to need, things like that. Shorter term type purchases. We define investing as longer term. Things like retirement, living expenses. If your kids are a really long way away from college, we would consider that investing. As they get to be 12, 13, 14, really it becomes savings. There's no real hard cutoff for a date, but try to keep in mind that investing is a long-term endeavor, number one, the actual time period, and number two, it's something that you're never done with. It's not like writing a book or something that you start and then you work on it and you finish. Investing is a lifelong endeavor. In fact, we have clients that have just had their 100th birthday, and they're still investing. They're still continuing to invest for their family needs, their living expenses, long-term care, medical, those type of things. And ultimately, in this particular person's case, to leave to a future generation. A lot of people come in the office and they say, well, I don't want to leave my kids anything that, I want to die, the last penny puts me in the ground. And that's fine too, but that investing has to continue for your entire life. So we want to keep in mind that in order to invest properly over this long term, you have to invest for some sort of growth. If you don't invest in things that have the ability to grow over time, you're not really going to get anywhere. And so people have a tendency to be overly conservative, especially when you look at the past 30 years where the bond market has done so well. People got used to just putting their money in treasuries and earning, a relatively safe 6-7% a year. That's just not realistic going forward. So just remember, investing for the long term, you want to invest for growth. That generally means something in the stocks. It doesn't all have to be in the U.S. It should be overseas. In fact, that brings us to our second point, which is always diversify your investments widely. That we want to be investing overseas. We want to be investing in the United States, small companies, large companies, some fast-growing companies. I personally have a bias towards what we call value companies, companies that are a good bargain for what you pay. Just like when you go to the store and buy a loaf of bread or a car or something like that, you're looking for the loaf of bread that gives you the best value for your money, or the car that gives you the most value for your money. So we want to do that, the same thing when investing, and typically you find the best values in value stocks. And remember, when you're investing, you're competing against some really very smart people. Almost 95% of the volume on the stock exchanges today is from institutional firms. It didn't used to be that way. It used to be, 50 years ago, less than 10% of the volume on exchanges was from professional firms. Today it's about 95%. And these are the people that you're trading with. And so you want to make sure that you're well diversified. I certainly don't think that the Wall Street traders, as we'll talk about in a few minutes, the index funds are your best way to go. But at the same token, you as an individual investor are at a significant disadvantage when trading with these. And we've chronicled that on the show throughout the years about the disadvantage that an individual investor has. So we want to make sure that you maintain a broad diversification, not just among stocks. Make sure you have different industries, different countries, look at different asset classes. We happen to like investing in real estate. We do like to mix some bonds into the asset class mixture. Another important principle investing is to ignore the short-term behavior of the stock market. You want to just don't pay attention to the day-to-day, week-to-week gyrations and news report. That information is meaningless when it comes to investing for the long term. It has no effect. One of the best things you can do is go look at some of the headlines historically about what was going on, and then look and see what the markets did. In fact, people are still, still hear this every day, people are still fearful of the 2008 recession, and they expect the next one to be right around the corner. They've missed going on 5 long years of an amazing bull market returns, where you could make a tremendous amount of money being overly fearful of what happened in the past. So we want to ignore these short-term fluctuations. Try to turn the TV off. One of the best examples of this is the weather. When you're looking at moving to a new place, you want to study the climate. The climate in Florida is generally warmer than the climate in, say, Maine. But it doesn't mean that on any given particular day in Florida, every so often they'll have freezes. It'll wipe out the orange crop. It does rain in Florida every now and then. But you don't want to make your judgment on the climate of Florida based on one day. You want to look at patterns, historical patterns of weather, and make your decision upon the climate. Well, we're coming up on our first break. When we come back, we'll continue talking about these investment guidelines. If you missed the first part of the show, head on over to our website, dlblain.com. There you'll find archived copies of the show. You can catch up with some of these timeless investment principles that we're going to be discussing today. So we'll be right back after the break. For All Things Money, I'm your host, David Blain.